Okay, looks like we're live. Welcome everybody. Midas Investing Live. Today we're doing a little bit of a different show than some, although in many ways a lot of stuff we've done this kind of stuff before. But we're having a show dedicated to just economic data today, kind of going through what the state of the U.S. economy in particular is, uh, and what we think the data kind of shows for the potential near-term future, especially in the light of all of the big changes going on with the new administration, anywhere from all the Doge stuff and as well as the tariff stuff. We're going to talk a little bit of both. Uh, Probably more focus on the tariff stuff, obviously, because I think that has more of an actual financial impact on things. But we'll talk a little bit about some Doge stuff too. But either way, the point is, are we going into recession? Are we not going to recession? Is the market bottoming? Should you be selling everything you've got, or should you be going max long leverage into the dip? We'll talk a little bit about all that stuff. But no talking about stocks today, though, at all. So that's going to be at least one little different thing about this. And my goal is to kind of do a show like this going forward once a quarter or after the quarter ends. So here we are, 1 week after the quarter ends. Hopefully, maybe it'll be less than 7 days afterwards, but I mean, whatever. It doesn't really make that big a difference. But my goal is to kind of do once a quarter an economic overview session where we'll literally talk about um, basically the same pieces of information, but kind of bring a new context of whatever's going on in the world. Give me one moment. My cat's being a pain in the butt. All right. Sorry about that. My cat's underneath my computer and trying to screw with some cords. It's become a bit of a nightmare if let him go too much. Mr. Beast, I see you in the chat there. Say my name. Say my name. How's it going, man? Good to see you. Hope you're doing well. All right. So before we get into that, I mean, obviously, right here in front of us, here's my portfolio. Not necessarily too much to say about that from the last couple shows, especially the show we did last week, our massive marathon live stream, 4 hours long, talking about nothing but FG. So if you want to know why I have one position that is so much larger than all the rest, and in fact, it's basically almost triple all the rest of my position sizes. Well, you can go and watch the 4 hour long live stream where I go in depth as to exactly every reason why. And as you can see, there's some sizable gaps in the allocation sizing that I have here for several of my other positions, but with the market declining, so I'm probably or potentially going to be adding to some of these positions as we go. I have actually added a little bit to Generac the last, so along with FG. Really, only things I've bought in the last um, week or two has been FG, Generac, a little bit of Lennar, and also a few more shares. That's pretty much it. And then beyond that, I've just been buying and selling ETF shares or put options and things like that. But anyway, so like I said, well, we're talking primarily about economic data today. So getting away from the portfolio, let's go and take a look at my business cycle tracker, which I first showed this about 3 months ago, near the end of the year. And so this is kind of going to be the core piece of our quarterly economic data discussions. Though I'm going to have several other charts to bring to the table. But if you might recall, 3 months or so ago, I was showing this off where I was basically trying to depict the archetypical pathway of a business cycle before, in, and around recessions. So what I had done was went back through history, all of the recessions going back to the end of World War II, and looked at a variety of economic data points, and basically measured relative to their cycle average or cycle median, what was the upward or downward momentum within those signals, basically so many months prior to recession and so many months into recession. So that's kind of what this chart shows, is that this line here, this black line here, is essentially the 0 point, right, when a recession begins. And then going backwards from this chart, you can see upward to 24 months prior to recession, and then 36, 40 months into the recession. So essentially 3 years after recession begins. And what I've done is at each point here, I've taken the median of all of the previous recessions that existed in, like I said, the post-war economy. So for example, if I'm looking at 13 months prior to recession for the stocks, what I did is I looked to see how much above or below average movement had occurred in the stocks at 13 months prior to all the recession. And then we took the median across all those values here, and then all the medians at those points in time are what you see on all these lines right here. Now, as you can see, we've broken the business cycle down into several component pieces, which are liquidity, profits, growth, stocks, credit, policy, employment. Wait, why do I have? There's a problem here. I think I doubled up when I was making the edits here. Two policy lines here. I thought I fixed that. I was making some adjustments to this right before the stream, so forgive me. Yeah, I just have it. I just have an extra one. Here. Doesn't change anything. But yeah, so policy and employment. And then in that, when I describe this, you'll notice I skipped over yield curve. So I do also depict the yield curve here, but that's not an independent part of the cycle. Really, it's just an exogenous signal that exists within the cycle that I included in this chart. I do think it's useful to understand. And so when I say each of these, to be clear, I'm meaning a very specific piece of economic data. You probably could have chosen 3 or 4 different elements to try to depict this thing. So for example, for liquidity, I'm defining that as the M2 money supply. There are a few other ways you could choose to quantify liquidity. And so other people, if they wanted to do a similar type of analysis, they could maybe have used different measures. But I basically just went with the M2 money supply. And then for the yield curve, specifically, we're referring to the 10-year and 2-year split. And then for profits, I'm referring to the S&P 500 EPS. For growth, I'm referring to real GDP growth. For stocks, I'm referring to the S&P 500 price change itself. For credit, I'm referring to the total loans and leases outstanding for commercial banks, which is a figure that Federal Reserve reports. And then for policy, I'm referring to the Fed funds rate. And then for employment, we're referring to the unemployment rate, the U3 employment. So as you can see right here, having the chart of those, you can see that in general, they all are above the kind of the zero line here. All these, considering they are meant to be an above or below trend median rate of change, that means that essentially they're all effectively the same measure here, where if it's a 1 or a -1, that essentially means you're essentially 100% above the within cycle median for that particular cycle. If you're a -1, that means you're at approximately a full trough relative to the above cycle median within that cycle. But as you can see, in general, going 24 months prior to recession, most of these series are above the zero line, which is right here. And then going into recession, they all decline relatively together, though at different rates, you'll notice. And then they reach kind of a trough, a bottom point within the recession, somewhere between like 6 to 12 months into the start of the recession. The starts of the recession, by the way, I'm defining as NBER designated recession markers as it's shown by the National Bureau of Economic Research. So specifically, like these points in times right here, is like whenever the bar is up, that's when you're in recession. Whenever the bar is down, that's when you're out of recession. That's just the official way recessions are designated here in the United States. Anyway, coming back over, you can see after it bottoms, then the series all start to move back up together after the recession roughly ends. You can see it's a little noisy. It's definitely, they all happen at different rates and different paces, but roughly speaking, you can kind of see the course of the business cycle within this graph. And then prior to the recession occurring, obviously the yield curve plummets to a massive negative point before returning back to a normal point right before recession begins. So if we go through this, like I said, this is what the kind of stereotypical archetypal business cycle looks like. This is the median across all business cycles, but what does it look like in our current business cycle? This is what all these measures look like as of right now. And so you can see the chart ends right here at the 0 point, which means that essentially this is where we are right now. And we're kind of looking to see like if a recession was to begin right now, does this picture right here prior to the recession look sort of like this picture right here, the before the recession? And I mean, you're looking between them, you can kind of see be honest, it's a very messy picture that's not very clean. But yes, no. I mean, there's some elements that definitely make it look like it's kind of recessionary, but then other elements make it definitely look not so. So we're going to go through each of these one by one and kind of depict like what's going on with each of these measures. Mr. B asked, what's the stocks line mean? The stocks line is referring to the average rate of growth for the S&P 500 um, within a current economic cycle above or below its trend. So if you're looking at like the stocks line and you're seeing like here the orange line is going like this, it's up. That means when it's up here, it means that at this point, which is about 1 year prior to recession beginning, 1 year prior to a recession beginning, stocks will have reached a peak in terms of the annualized rate of change that they got comparatively to essentially that particular cycle. So like if you'd say that since the end of the last recession, if stocks had on average returned, say, 8% per year since the end of the last recession, and then here it's showing it's about 60% above that, then that means at this point in time, you would say that for the last 2 years, stocks had returned instead of 8% per year, they would have returned more like 13% per year or 10% per year. That would be more like 6%. I don't know why I did more than doubling. So it's like if 8% per year is essentially average, then you would assume that it'd be more like 9 to 10% per year for the previous 2 years as of this point. So it just basically it shows that stocks would be peaking prior to recession, and then it starts to come back down over time. And in this particular case, it shows that it goes to a negative zero point 0.8, which means that, like as I had said, if the average stock had returned maybe 8% per year in the period prior to recession, that means at this point, for the 2 years prior to this point, you would have returned basically a negative 6% per year. On which data the line is based? It's based on the S&P 500. It's based on the S&P 500. Uh, Specifically, the average movements of the S&P 500 around recessions for all recessions since the end of World War II. Uh, and then, well, like I said, we're going to go through each of these charts one by one so we can kind of look at it more neatly. As I was showing, this is all the pieces as they are right now. And if you kind of look between them, you'll see that liquidity is low in prior to recession, which sort of makes sense. As I said, we're on which data the line is based. All lines? No, just the stock line. Just the stock line. This orange line right here is based off the S&P 500. The blue line, liquidity, is based off the M2 money supply. The yield curve is based off the difference between the 10-year and the 2-year treasury rate. The profits, the yellow line, is based off the S&P 500 EPS. The green line growth is based off of US real GDP. And then purple credit is based off of loans and leases of commercial banks in the United States. Policy, Fed funds rate, employment, unemployment, the unemployment rate. So anyway, coming back over to the liquidity chart, taking a look at this, like I said, this is kind of the stereotypical cycle across all the cycles, but for all the elements. But now let's just look at them one by one. So this is basically, we're going to be looking at this exact same chart right here, but only one line at a time. So first, if we look at the liquidity line, this is what liquidity looks like prior to recession. Usually liquidity is very, very weak, which means M2 money supply growth has been weak, which means that there's less new money out there to essentially fuel the growth of stocks and the economy as a whole. It'll often, as it appears, seem to try to make a recovery prior to the recession, but then for some reason or another, that kind of recovery seems to fail, which is kind of interesting. It's hard to know whether or not this is just kind of a spurious movement based off of the limited data set of recessions that we have here, but the fact that the median movement causes a like quasi recovery in liquidity before the liquidity recovery fails is kind of interesting. And then that trough period reaches kind of like a major low point in the recession, and then it properly recovers once we're actually through the recession. About 1 year into the recession, it properly starts to recover before then eventually declining. I think that has to do partially with the Fed or the government coming out and doing monetary easing and supplying liquidity to the market. So that's kind of what I think this kind of motion is essentially a huge growth in the money supply caused by fiscal or monetary policy, and then that money supply growth starts to wane off again after the recession has ended. But anyway, looking at where the current liquidity picture is, which is this one right here, you would say that this definitely is kind of in line with what we expect the recession. We're not getting this kind of upward movement and then failure but we have reached trough. It's starting to kind of try to recover, but it's had a lot of difficulty with it. Now, I would say that the difficulty with this particular element is that it has been in a trough for quite a long period of time, partially because of the tightening cycle we just went through with the Federal Reserve. That basically them raising interest rates and pulling reserves out of the economy. That is them declining the M2 money supply. So that's why we have this negative period right here. Whether or not it's going to drag us into recession is an entirely different question. And then obviously, as you can see, we've been in this negative trough for liquidity for basically 2 full years at this point, or really more than 2 full years, because obviously we're negative prior to the period right here as well. So moving on from liquidity, then we can look at the yield curve. Now, as I had kind of showed you, this is the typical path of the yield curve, is that it's positive, and then somewhere around 18 months prior to recession, it goes massively negative and inverts. And then once we get close to recession, within like a 3 to 6 month period prior to recession, it actually uninverts, and then that's when we go into recession. Or it means kind of roughly flat past that point. Really, that's the only exogenous kind of movement within that cycle. Now, likewise with liquidity, we've been negative in the yield curve for quite some time as of this chart, and then we actually have uninverted in the recent few months, which it doesn't show a positive figure for here, but it's worth noting that this is not based off of whether it's inverted or not inverted. It's based off of whether or not it is above or below the within cycle median. So if the median difference between the 10-year and the 2-year was positive over the cycle, then that means getting to zero doesn't get you to zero on the line. You actually do have to go up to that median level. So while it did uninvert in the last like month or two, the yield curve did uninvert. That doesn't mean that it goes to positive territory on this chart, because it still would be below its cycle median. But nonetheless, either way, we were massively negative, and then we mostly have inverted by this point, I would say. But based off that, you could also argue that maybe we're a few away from the recession if it's supposed to unvert fully prior to the recession, or not unvert, if it's supposed to re-achieve its cycle median prior to the recession. So that's, I'd say, 2 for 2, or maybe 1.5 so far, that we would say these pictures kind of look like they should for a recession. Moving on to the corporate profits, which, as I already stated, we measure using the S&P 500 EPS. So this is what the path that the growth of profits usually takes prior to recession. It's usually relatively positive 2 years prior to recession, and then for the 2 years kind of approaching recession, it starts to wane pretty significantly, going negative well before recession. Again, negative in terms of above cycle growth, and then it starts to go down, 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 and it reaches kind of a trough about 9 months into recession before it slowly starts to recover, taking a little bit of a zigzaggy path to recovery. Yeah. China calls for discussion. I assume you're talking about trade discussions and retaliatory tariffs and stuff. Yeah, interesting. We'll see what happens in the end. I imagine there's going to be a lot of noise surrounding the tariffs in the short run. Like I'm sure every day there's going to be some new headline saying they're talking with this person, they're talking with that person. These talks have broken down. Those talks have broken down. It's like, so it's one of those things where it's like I would almost ignore all of the headlines in the short run, because I'm sure that they will call for discussion, and then the discussions will break down, and then they'll call for discussions again, and then discussions will break down. So it's almost one of those things where it's like I wouldn't trust it until we really like actually get something super solid, to be honest. But we'll see. Out right now, I've seen the futures dump, and I don't know why. Interesting. Um, yeah, I'm not looking at futures right now, but yeah, back to this though. So what I will say within this picture here, obviously, you see that we reached a trough about a year ago, and then corporate profits have actually started to reaccelerate in terms of their growth. Now, it's possible that that's going to start to turn around again. Um, what with a lot of the positivity surrounding the AI picture having started to wane a little bit, and then also the tariff things on top of that. So it's possible that we could just turn right back around and head back down. But nonetheless, as it's currently depicted right here, it's much more of a positive picture. Makes it seem like we're actually coming out of the trough rather than way for this particular one. Then moving on to real GDP growth. Here you can see prior to recession, it's kind of lulling a little bit above trend, but usually kind of weak, not necessarily a super strong figure. And then it rolls down into negative territory as we go into recession, and then it starts to recover as you would expect. And then with that, where we currently are, we're definitely kind of right in line with that. Still in positive territory, but just barely above it. So definitely, this is another one where you can say the picture kind of looks like the stereotypical recession picture. And so far, to make that clear, that's liquidity that we say is pretty reasonably recessionary looking, the yield curve that is reasonably recessionary looking, growth that is reasonably recessionary looking. Corporate profits we think don't really look quite like the recession picture as of right yet. So then moving on from growth, we can also move on to look at the stock picture. Is what stocks typically look like, moving above their trend growth. That trend growth starts to break down about 1 year prior to the recession, but still remaining above the positive growth trend, and then going below the positive growth trend about 3 months prior to recession, and then going down and down and down, reaching a trough about 6 to 9 months into the recession before starting to recover. So where are we with that? Well, we were 2 years ago, coming out of a trough, out of the kind of 2022 bear market that we went to, and in the 23 and 24 where we had raging bull markets. That's kind of what you can see on the line right here. And then we've reached a pretty solid peak. And then since the peak in the last couple of months, obviously we've started to trail off pretty significantly from that right here. So as you can see, as of right now, it definitely doesn't really look quite like the recessionary picture. But maybe 6 months from now, it will start to look like, maybe 3 months from now, it look like that. Hard to say. Obviously, you could kind of shift this line backwards so that this peak is kind of lined up with this peak, and maybe take an estimate based off that. That would kind of make it seem like maybe it's like 9 to 12 months away or something like that. But each of these you can kind of play with a line to kind of like, get an idea of what you think's happening. But it's a little bit, trying to paint a picture based off of the one element I think is tricky, but doing it with several at least to paint a little bit of a clearer picture. Moving forward from that, we have also the credit cycle. So this is like how much loans are actually being extended to businesses to try to grow the economy. And here within the cycle, you can see generally it's pretty positively above trend. That trend starts to come down pretty significantly prior to recession, and really it only properly deteriorates and goes negative into the recession. So this is definitely not a very strong leading element. Definitely more of a concurrent element. It starts to go negative once the recession is properly occurred, which makes sense. Is that banks recessions don't occur because banks aren't giving out loans for the most part. Recessions happen at the same time as banks stop giving out. Right? It's like banks stop giving out loans because of the recession in many ways. So it sort of makes sense that this is like how you would expect it to happen. Now, the interesting thing about this series, as you'll notice, is that it doesn't really depress too heavily, even during a recession. It remains depressed for quite a while. It does take kind of a while for it to recover, taking almost 2 years for it to actually recover back to above trend. But it doesn't really collapse into like a massive below trend level, which is kind of interesting to see relative to some of the other series. But nonetheless, looking at where we currently are, we were at a very high above cycle point, and then we've come down pretty significantly since then to below cycle. Now, one thing I haven't mentioned up to this point is that for each of these, the more extreme the high point or the low point is, um, for these measures, the more extreme the reversion will be too. So the fact that we were really high up here means that as it comes down, you're almost inevitably going to go low below the zero line pretty significantly. A little bit of like a mean reversion to both ends of it in that sense. So, long way of saying that this looks massively negative, but it could actually recover pretty quickly as long as things remain stable. Obviously, that's a big caveat. It relies on the idea of everything remaining stable, but nonetheless, that's the situation. So then moving on from that Okay, so then moving on to the policy one. Policy being the federal funds rate, as we talked about. Mr. Beast's last comment there. If trade deals start to closing, it will be from recession to growth. The goods had big declines. Yeah, definitely. That's definitely a possibility. As people like to say, markets like to climb a wall of worry is the common phrase people like to put out there. So it's like almost the more worry and cause for concern that people have out there in the market in a kind of a public sense, like people are very bearish right now, it almost creates a dynamic where you can almost go nowhere but up. Because like if all the negativity is priced into the market, then that means as the negativity either comes true, which would have a neutral effect since it's already priced in, or B, if it's better than expected, then it would have a positive effect, right? It almost creates a dynamic where things can be more bullish than you expect because of all the worry essentially baked into the market prices. Now, the assumption that underlies that is that it is baked into the prices. So that's the one thing I would say with that is that if everything is really well priced in the S&P at this point, then yes, I would agree with you that if we start to get some trade deals, we could definitely go from recession to growth pretty quickly. And then as far as the goods declines go, well, save that for the second half of this stream because we're definitely going to be talking about um, goods to a pretty significant degree once we get through this business cycle archetype picture. We'll definitely go into a lot of the fine detailed elements of what makes GDP tick and the kind of leading elements of it. Some of the other stuff I want to talk about. Anyway, so looking at this is the policy rate. Federal funds, as I said here, federal funds usually is actually kind of going into a little bit of a tightening prior to recession, which is kind of interesting. Is that oftentimes tightening occurs only like a year or two prior to the recession, and many times kind of causes the recession because basically the tightening went too far. But here you can see the tightening peaks usually about a year prior to the recession. Then it starts to roll off pretty significantly. Again, this is a rate of change thing. So with the roll off, it doesn't necessarily mean that they've started to cut rates. It just means that they were no longer tightening them. They were no longer raising them at the same rate as they were previously. But then the cutting does kind of still occur somewhere in this slope right here. And then really, as you can see, the policy rate doesn't really reach an actual trough until like 9 months the recession, going to show that really they start to cut rates once the recession has showed up, right? Like they don't cut rates preemptively to a massive degree. They might trim rates down a little bit, move them up a little bit, kind of keep things pace as they've done in the last year or so. But they're not going to cut down to near zero, just cut. They're going to do it only once the recession really is properly begun. That's just the nature. Those last few comments, even though the S&P, the inflation goes fast down because of recession, I'm afraid, not even 100% sure what you meant by that. It's far more important than the S&P decline. Uh, talking about inflation coming down because of recession. I mean, that's very typically the case. We haven't even gotten to the inflation chart yet, but you'll see that that's painted. That picture is painted pretty clearly in my chart for inflation, which we're going to get to very shortly. So moving on from the policy rate. Oh, well, not moving on from it. As I said, the stereotypical path is that it comes down prior to recession. As you can see, we've gone from a pretty tightened level down pretty significantly recently. Now, again, that's not as I said, this isn't because we've had massive cuts. We haven't had massive cuts, but what we've had was a period where we were raising at a massive rate, and now we've come down to a period where it's been stable for a long period of time at the same rate, which means we've leveled off. Now, the one thing I'd caveat with that is that you'll notice that that the red line is on the right scale, whereas the blue line's on the left scale. For most of these charts, I've had them on the same scale, and that's because they weren't so significantly different that it didn't really matter. But for the policy rate, it makes a massive difference. Here you can see the scale goes from 1 to negative 0.25. Here it goes from 80 to negative 20. You can see it's like literally like 100 times more extreme of a value. That partially has to do with just how extreme of a tightening cycle we have. As you probably heard people say, because of the fact that we went from 25 basis points up to like whatever we ended up at 5.5% or whatever, then that people were like, oh my gosh, we've never had a tightening of 1,200%, and that's what they mean by that. That they 1,200%ed the starting point of 25 basis points. So this extreme curve right here, in many ways, is kind of like the reverse of that. It's just that because of the fact we tightened so much so quickly, then the slowdown from that tightening causes this decline right here. But the actual value of this point right here is a 1.02, which on the left side, which is where the blue line is, you can see is actually up here. So if I actually did have them on both on the same side, then this red point right here that's close to the line on the graph would actually be way up here, going to show you that technically speaking, we're still quite tight. We're still quite tight, well above the trend level. So it's just kind of a funniness of the depiction of the graph. It kind of makes that a little bit misleading. It makes it look like we've loosened a whole ton right here, but in reality, this actually is way up here still. Wheezy, what's the hit rate of previous recessions? Did others have some, but not all of these trends? Sorry if you said this already. No, that's a very good question. I can't give you the exact numbers on hit rates for each of these because what I'm trying to do is I'm trying to build kind of like a composited average signal, but you'll still sort of get your answer here shortly. Um, because was like the way I compose these is that like at each point of this graph, like right here it says -6 for liquidity. So that means 6 months prior to recession beginning for liquidity. And then this point, like this data point right here, is actually the median of all of the values of this measure at 6 months prior to recession for all the recessions since the end of World War II. So that's why I say it's like I don't have the hit rate for you because all I did with this graph was essentially make a kind of a composited average. But I have something similar to that overall, which, like I said, I'll show you shortly. So just give me a minute, and you'll kind of see what I mean. And then, like here, I just pull up in this chart so you can see sort of what I'm talking about. Here I've shown this is the liquidity page where I have it, and then I have right here the recession that begins in 2000 at the end of 2007, the recession that begins in 2001, the recession that begins in 1990, 1981, 1980, 1973, 1969, 1960, 1957, 1953, 1948. And then you can see I have the values for all those points starting 22 months prior to recession, going to 48 months after the recession. And that's what I did for basically all these right here. And then what I did is I took the median of all of those points. So like that's how I put these measures together. So like to give you like the hit rate as you kind of are asking about, I would sort of have to look at each one of these and say, okay, did that successfully do that exactly that motion prior to recession, and did this one do exactly that motion prior to recession? Which isn't like I said isn't really what I did. But like I said, I can give you kind of an overall answer to that question here shortly. But like for each measure, I can't because of just kind of uh, how it's put together. But anyway, moving on with that though. So from the policy chart, we kind of finished talking about this one. We have two more to talk about, and then I can kind of show you what I mean. There's the employment chart. So employment is probably one of the most important measures out of all of these cycles because at the end of the day, it's like if I'm looking at all the cycles, these are all the cycles across their kind of median path. The employment one is kind of the one that I'd say makes matters the most. Like in a sense, like all these things, what we really want to know is when unemployment is going to spike, right? Like we talk about growth, people talk about GDP growth, and they talk about economic growth, and they always think about GDP. But like at the end of the day, it's not GDP that we care about. It's unemployment we care about because unemployment is the thing that decides whether or not you're going to be in that like negative growth period for a long period of time or if it's just a brief thing, right? Like in 2022, we had 2 quarters of negative GDP growth and they didn't declare a recession. Why? Because unemployment didn't go anywhere. So it's like that's what they call a technical recession versus a proper recession. And a proper recession, which is declared by the National Bureau of Economic Research, they don't just look at GDP. Like people like to quote that in the financial media. They'll be like, "Oh, GDP declined for 2 quarters. That's the definition of a recession." It's like, no, that's not the definition of a recession. That's just a that's just like a simple kind of rule of thumb people like to use for recession, but it's not the definition. The definition of a recession is a broad-based decline in activity, investments, and employment, which requires unemployment in particular to decline. So anyway, looking at the unemployment chart, I'd say this one is also probably one of the cleanest looking images of the recessionary path too. Like, doesn't this just look like a very clean decline of a chart relative to I'd say the other ones? I mean, like this has a decline, but it's kind of bumpy. This one has a decline, but it's kind of shallow and also kind of bumpy. This one has a decline, but also is bumpy. This one's a little bit smoother, but not also kind of shallow at some points. Um, but the unemployment one, it's like that literally looks like a stock chart, almost kind of interesting in of itself. But yeah, so unemployment's usually relatively strong relative to the trend growth. That trend growth starts to break down. Going into the recession, it's usually like declining prior to the recession, but it's not really breaking down until you're in the recession. Hitting it doesn't even head below the trend of the current cycle until like 6 months in, and then bottoming kind of like 9 to 12 months in. So yeah, employment is easily the most lagging aspect of the business cycle, or I shouldn't say most, one of the most lagging aspects of the business cycle. And as which is why it's tricky to predict recessions, because you can have a decline in liquidity, you can have a decline in profits, you can have a decline in growth, you can have a decline in stocks, and you could still not have a recession. Like all those things could go negative and then still recover without you actually going into official recession, because employment didn't decline. Now you'll notice that when I said those few things could all decline, I left credit out. Now there's a reason why I did that, and that's because credit and employment are actually more closely correlated with each other than basically all of the rest of the series. You can, if I come back over to, honestly kind of hard to see in this picture. But yeah, it's a little hard to see because of how many lines there is here. But if you look at the purple line, which is credit, and then the kind of the deep red line, which is employment, you'll see they're very closely aligned with each other throughout this entire period. I guess I could, what I could do is I could me probably put it on top. There. Okay. So yeah, here with the blue line and the yellow line, I put them on the same axis so they're in line with each other, and then they're next to each other. To see how closely correlated they are with each other. When credit declines, employment declines. And I think that's a very important thing to understand out of all these cycles, because the relationship between those two, I think, really helps to understand like why these things move together. Think about it. It's like if a company can't take on new loans, it means it's probably not able to pay its bills, which means it's going to start workers off. Those two things will be very, very tightly correlated. They weren't correlated following COVID, right? I I would say they still were correlated during COVID. Um, they're not correlated at every exact single moment. It's not like, I mean kind of broadly, right? Obviously, like for example, here you can see this was moving down while this was kind of flat, and this was moving up while this was kind of flat. But like over the course of the whole path, it's pretty well correlated, right? So like what I would say about COVID is that like when COVID first struck, we saw a massive decline in credit. We would have seen a massive decline in the credit being extended, at the same time that we had unemployment going down. So initially, as COVID first hit, they would have been very correlated. And then as the workers were then given relief, but then the credit wasn't re-extended, they would have become pretty negatively correlated for a few months there. Once like a lot of the stimulus was starting to go through, and like once kind of the kind of essential worker kind of setup, and like once all the kind of like we knew what we were doing COVID, like once we were a few months in and everybody kind of had to idea of like what was going on, they were probably pretty negatively correlated for a little while. But I would imagine that they probably became pretty correlated again within like a year after COVID. Because think of it this way: like once all the money printing started, which really started to begin like 6 months after the start of COVID, and really didn't really get start revving up really over like a year past COVID, was really when the money printing started going in earnest. All that money would have then been cycled into credit. So it's one of those things where it's like there would have been a brief period there where they would have been very negatively correlated, but then they would have realigned. Um, oh, my bad. You thought I was referring to delinquency. That's fair. Hey, I mean, to be honest, I think there would probably be a decent correlation there too. Because I mean, credit and delinquencies would be kind of in mirrors of each other. It's like this is basically the rate of change of the credit being extended. But you can bet your ass that if the credit being extended is negative, the delinquency rates would be up, right? So like there definitely would still be a pretty decent relationship there. But yeah, I'm talking about specifically like this is kind of like a rate of change of the dollar volume of credit being extended to business. That's what this measures. Mr. B seems to believe Micron is flying high tomorrow. For people who are looking at individual stocks, as I said, today's not a day for individual stocks. But for any of you Micron longs out there, Mr. Beast is bullish. So anyway, moving on from employment, we'll move on to the inflation chart, which is the last of the individual cycles, and then we can look at the composite cycle as a whole. Inflation which is also an interesting one, pretty important to understand. And it has a pretty different dynamic than most of these, as you can see. It's usually relatively it's above trend, but not to any extreme levels for like the year and a half prior to recession. And then prior to recession, inflation tends to spike up, which is kind of interesting. Kind of interesting. A lot of people talk about the fact that inflation comes down in recessions, but I think a lot of people tend to not talk about the fact that inflation is actually often peaking at the start of the recession. And many times it's those high prices that creates problems in the economy, depending on what's happening. The fact that the prices are high could cause the demand to roll over, which could cause a recession, or it could cause difficulty input prices, profitability, things like that. But inflation tends to peak 6 months into the recession, and then and only then does it start to collapse down below trend. Which, by the way, this picture right here, this picture could explain why it is that inflation is not back to the 2% target. Like this basically should explain to you why, because we didn't go through a recession. We have not gone through a recession. Now, as I've kind of painted through a lot of these pictures, there's plenty of these elements that are um, recessionary kind of signaling, but there's other ones that are kind of in recovery as well, or have never really been negative as of yet. Though obviously we are starting to decline for the stock ones in particular. So it's like for half of these elements, you could argue that we're in recessionary territory, and for like half of them, we're really not in recessionary territory. Definitely a very mixed bag. But then looking at the inflation one, obviously we broke down way below trend a long time ago. Yes, we're not back to our 2% target, but obviously we were at 9%, right? So we've broken down pretty solidly below trend, which while it is above 2%, that does create a tailwind to the profitability for companies previous relative to that previous experience of 6, 7, 8%. It's only a fear of recession. Hey, I mean that's in many ways what we're here to discuss, Mr. Beast, is how scared should we or should we not be of the recession? And to be honest, I mean, what my kind of conclusions, I'll kind of like front run my conclusion. My conclusion basically is we should just wait and see. The conclusions that I'm going to paint you is that there's a lot of the data points I'm going to show you that could give you reasons to fear that we're going into recession, but none of the data points really indicate that we're already in one. And that's the thing I think I really kind of at least want to drive home is that maybe we go into recession, maybe we don't. But we're definitely not there yet. And bringing that, I will say, to the stock market discussion, it definitely feels like the stock market is pretty pricing in a pretty significant recession to a certain extent. So it's possible that, I mean, we could be bottoming on that basis, but there's a lot of assumptions there. It depends on just how real or not that those recessionary fears are. Anyways, moving on from inflation, let's take a look at the composite, which will kind of get around to answering a little bit of the questions Wheezy was asking about. So taking all the different cycles that we've talked about here, all these different elements, and then kind of the picture of where we are currently. I showed you like these are all those cycles separately, and then this is the image of where we are currently for each of them independently. What I like to do is then essentially take all of them and then take the median of all of these together. So like all of these are medians for each of those individual series, but then what's the median across all these for each of these points in time? So if I was to say like take all these lines and just turn it into one line, that's what we want to do. Is we just want one line to look at to decide what's our business cycle look like? Going into recession, are we not? And this is the line that I came up with, the blue line. So blue line, this is what the composite signal of the median pathway of our business cycle looks like going into recession. We're high prior to recession. We peak about 15 months prior to recession, starting a decline that lasts about 15 months, reaching close to zero at the 0 point. But really, it takes us like 1, 2 months before we really reach the 0 point. So a little bit late of a signal, 2 months late on a median case basis, which might sound bad, by the way, but most economic indicators take several months or a couple quarters to really release, and the NBER on average takes like 8 or 9 months to declare a recession. So if I can declare a recession 2 months in versus 8 or 9 months in, then you're actually already doing a lot better. That's so. Just I will caveat that because a lot of people will look at this and be like, well, if you didn't predict it, it's not useful. It's like, well, you don't need to predict something 6 months out. There's a lot of value in picking where you are right now and accurately saying where you are now. Because a lot of people can't even say where they are currently, let alone where they're going to be 6 months from now, right? So that's the thing. It's like this whole thing, this whole discussion is not about predicting recessions. It's about trying to understand more accurately where we currently are. So anyway, with that aside, this is the median pathway going into recessions. As I said, it dips down approximately at the start of recession. It troughs about 6 to 9 months into the recession and then starts to recover. Full recession lasting a little bit more than 2 years on a median case basis. And then the red line is where we currently are if we assumed that the recession was starting right now. And then the yellow line is basically I just took the red line and shifted it forward 6 months. So I said, okay, well, instead of assuming the recession starts now, what if we assume the recession starts 6 months from now? How does that depict? And obviously, technically, the yellow line is closer to the blue line. So that would argue that maybe it's more like 6 months away. But like I said, the point here is not really trying to predict as much as assess and observe more than you know. Mr. B started buying Ethereum. Dang, really looking for some high octane returns there, aren't you? But best of luck with it. Best of luck with it. So anyway, Wheezy, to give you sort of what you were asking for. Now we're finally to that point. This blue line, where with this composite cycle, and the red line of where we are currently. I took the red line and then carried it backward through history, through the entire history of this data set, and basically said, okay, well, what does the signal look like over time around all of the previous recessions that we've had? And that's what this chart is. Okay. Uh, so this, like I said, I can't tell you the hit rate of each of the individual series that went into this, but this can at least kind of show you the how good or not it is at predicting recession. This is you can kind of think of this as almost like a thermometer to the business cycle. Positive, the economy is booming. When it's negative, the economy is receding. Then the blue bars are those NBER designated recession. So you can see like, just how well it's done. It's not a perfect signal. It has false positives, as you can see, and for some recessions it goes into negative territory a little bit late. But overall, I think it does at least do a pretty good job of taking the temperature. Like I said, here you can see like 50 is pretty solid positivity. This one it did really well for the 1953 recession. It went negative early. That's good. Let's see, going on for this one, for the one in 1957, it also went negative, basically right on time. Then for this one right here in 1959, it did go negative, but it went negative late. Really, we didn't go negative until basically near the end of the recession, but the recession itself only lasted like 9 months. So admittedly, it was a bit of a short recession, which, like I said, the NBER themselves tends to be a little bit late when they declare a recession. So oftentimes they're declaring a recession right around the time it's over. So that's worth noting. Anyway, let me carrying through here for the recession in was 1971, 1970. 1970, we actually went negative a few years early. So this one we had an early call, like almost 3 years early. So like that's so early that we would say that that's not super great, right? But it did remain negative through the entire time frame. So it was a bit of an early call, but it was a correct call. And then for 1972, 73, it had a bit of a late call. Then in 1980, it actually basically missed the flash recession of 1980. But a lot of economists actually refer to this recession, this next one, the one in 1982 and 1980. A lot of them kind of refer to these two recessions as the double dip recession. A lot of people think of it as like maybe this should have all been one giant one rather than consider two separate ones. So if you did consider it one giant one, then you could argue that this signal, while it was late, it at least still achieved the signal well. But you can argue about that all you want. Here in the mid 80s, in 87 to 88, we went negative before recession actually occurred, and then went positive again. So this is a little bit of a false signal here, or early, depending on how you want to think about it. This one worked pretty well. This one went negative a bit early, went positive again, and then went negative again. This one's within a year though, so I feel like that one's like while it's early, I feel like it's a reasonably okay one. Not to mention the 2000s was a little bit strange recession, so because of the tech bubble bursting. And then for the housing crash, this one worked out pretty well. It wasn't super early, but it still at least went into recession well before the official recession was declared, and then remained a little bit later or so. Then through the boom years of the aughts, it worked pretty well. And then around the 2000s, we actually didn't for 2020. I mean, it didn't actually go negative for that signal, which I like I said, I fiddled with this signal a lot of different ways. I adjusted it in a lot of different ways, kind of trying to make it work a little bit better. And then one of the things that actually mattered to me when kind of putting this signal together is that I really wanted to successfully show that 2023 and 2024 were boom year. It was for a lot of these signals. It was not hard to make 2022 seem like a negative year, what with the tightening. But it seemed, in my opinion, if this signal was going to be any good at all, it sort of needed to correctly predict the weakness of 2022, but the strength of 23 and 24. Because I think that predicted that most commonly predicted recession that did not occur in 2022, myself included, and the people who were predicting it. I think like understanding what happened there is pretty key to understanding the current economy. So I would say that the dynamic you see here, where it goes really really low right here, but not negative, and then it goes really positive again before declining in more recent months, in my opinion, is about as accurate a picture as you can depict of what actually happened over the last 3 or 4 years. So overall, while it's not super perfect for some of these past recessions, the fact that it basically did the last decade or so really well, in my opinion, is one of the reasons I'm happy with the current kind of tuning of this signal here. So hopefully that satisfies what you were after, Bweezy. Is because I assume what you want to know is basically like how useful is all the stuff I'm talking here. Is like is this something that that you can kind of take home to the bank? And like I said, it's like I wouldn't necessarily say you could assume that each of these individual lines is going to happen like this in and around recession. Like I said, it's like it's a median pathway. So there's a lot of things that can be different. Every recession is different, and stuff like that. But on a composite basis, when we've kind of put all the pieces together, we've kind of blurred out all of the outliers. Then this is what the typical pathway of the recession is like. Now, a few other things I kind of wanted to show as well. Um, the thing now, obviously, we're stock market investors, so we care about stocks, right? And you'll notice that as I kind of showed here, is that stocks tend to decline pretty significantly prior to the recession. They decline pretty significantly in the recession as well, but they usually decline from their peaks pretty significantly prior to the recession. And in many ways, that's kind of the situation we're in right now, right? We've declined pretty significantly from our peak levels, and now we're wondering if we're going to a recession or not. And maybe we do, maybe we don't. But if we do go into recession, we almost certainly will pick out new lows, right? Like we'll almost certainly probably double up on the drop that we've had so far on the S&P that we're referring to, like the distance from the highs of the S&P 500. If we actually go in recession, I imagine we'll double that distance. But if we don't go in recession, well, then we might have bottomed already, right? That's the tricky part. The tricky part is wondering like which of those two things is true. It's like, are we bottoming now or are we only halfway there? That's basically the question, right? So the reason why I bring this up is that the fact that the stocks decline so much sooner than the recession begins means that all this business cycle analysis is not necessarily going to be a super strong predictor for stocks themselves. In many ways, that makes sense because stocks are included in the predictor element. So one of the elements we did include that is pretty relevant to stocks is liquidity. Liquidity being basically like the excess cash flow to bid up prices is very relevant to the pricing of equity value. So one thing I did in particular, well, similar to kind of like how I was showing you kind of the correlations between employment and credit in and around recessions, I was very curious to take a look at the correlations between stocks and liquidities as well. So here I show you the 3 year rolling COGR of the S&P 500, just the price returns, not including dividends, but just the market value. And then the blue line, it's not labeled, is also a 3 year rolling COGR for the M2 money supply. And they're on different axes so that they can have different extremities. The stock price is going to be much more extreme in their movements relative to the M2 movements. And the thing I'm trying to show you here is that there are periods of time where stocks and M2 are highly correlated. Now, there are also periods of time where they're not really correlated at all. So that's the thing you kind of want to look at this picture is kind of like try to look at it um, by chunks of time. Like right here from do the 60s, there wasn't really that strong of a correlation. They were positively correlated, but not like very strong correlation. Then in the 70s, they became very tightly correlated for this kind of period right here. Then in around 1980 or so, they start to be negatively correlated for a period of time. And then for like kind of the mid 80s, they're positively correlated, but kind of but more weaker, a little bit closer to where we were in the 60s. Then in the 90s, they became negatively correlated. And then in the second half of the 90s, they began to start to become much more positively correlated again. And then became negatively correlated again around the great financial crash, and then have become much more positively correlated since then. So there are periods where it is correlated and periods where it's not correlated. That's something that's important to understand about liquidity in stock. Before we move on from that, Andrew Marshall, how's it going, man? Fuhat showed me your channel. I like your stuff. Thanks, man. I really appreciate that, and I always appreciate Fuhat sharing my stuff. He definitely been one of my biggest cheerleaders ever since I started my channel for sure. But yeah, so welcome to the channel. Give us a like, give us a share, stick around. Go check out some of my previous streams, previous videos, stuff like that. Hope you stick around. So anyway, taking this image here now, this is the entire history, right? This is it going right up to the most recent couple months, going back to the 50s. Now, what would happen if I did the same thing, similar to as I was talking about with these previous charts, where we're kind of looking at it in and around recession? So if I look at instead the kind of the role of liquidity versus stocks in and around recessions, this is actually what we end up with. This is basically combining that stock chart, the blue line on this one, with the blue line on this one. Now they're going to end up being blue and red, but you see now they're in and around each other. And you'll notice that at the 2 year period, again, this is the median case in and around recession. 2 years prior to recession and into 3 to 4 years in and after a recession. So prior to recession, 2 years prior to recession, there's some correlation, but they're kind of just still moving somewhat in their own way. Like there's definitely some positive correlation there, but not necessarily tightly correlated. And then around 6 months prior to recession, they suddenly become pretty tightly correlated. And they stay pretty tightly correlated, going in and out around to about 2 years after recession. And so this is something that I think is important to understand. It's like the combination of this chart and this chart. Like this is the chart of all of the periods of correlation or non-correlation between stocks and liquidity. And then this is the chart that shows what stocks and liquidity does around recession specifically. And so the one thing I think that really explains that correlation is essentially a liquidity crunch. Whenever you end up with a liquidity crunch around a recession, stocks plummet. So that's kind of the last little conclusion piece I want to show you here. Like I said, it's important to understand where we are in the business cycle, but understanding where you are in the business cycle does not necessarily give you a good understanding of what's going to happen with stocks, because unfortunately, knowing where you are in the business cycle means that stocks may have already declined. So instead of focusing on the business cycle, if you want to understand where stocks are going, you actually need to focus more on liquidity, which is a whole separate subject. And frankly, I'll probably have another stream another time to talk all about liquidity in terms of how to use it for stocks and all different things. Mr. Beast, bro, I was watching you alone. Mr. Beast has also been one of our long-standing cheerleaders of the channel, that's for sure. It's like between Mr. Beast, Boo Hat, and Well Invested. Like you guys are probably the the three top dons of the of the fandom, I guess we could call it. So anyway, this is it with the business cycle. Now, oh well, one last level, I guess, which is say let's come back over to the composite signal. We were talking about whether or not it was in line with the the composite signal, but the current signal is in fact negative, right? So that's one thing I will say. Let's keep that. Let's notice that. Let's take that into account. Is that we have gone into negative territory with this signal. So we'll see whether or not we go into recession or not. We are definitely in potentially moving into recessionary territory. And then the other thing I'll say in an addendum to that is that this doesn't necessarily have to do with Doge or the tariffs. We went into negative territory with this signal 4 to 5 months ago, which admittedly was around the recession, around the election. But you'll notice that we were already going pretty significantly declining for the whole year prior to that, right? So it's like, well, yes, there's all the tariff concerns and people worried about layoffs and Doge and all those things, and maybe those things will contribute to recession. But I will say the economy was clearly already weakening prior to that. It's like we were coming down from a significant expansion period, and we had gone into negative territory. But as I've shown here, there are plenty of periods of time where you go negative and then you recover and don't go into recession. So just because we're in negative territory now does not mean that we are in fact going into recession. It just means that we are at risk of going into recession. But we'll see. We'll see what happens over the next 3 to 6 months. Like I said, we'll do this. We'll do basically a similar overview of this information every 3 months, and my plan is to do this each quarter. So even though the data comes out mostly on a monthly basis, so really we'll have like 3 data points to look at more each time. But yeah, so that's kind of where I'm at with the business cycle. Now, there's other things I did want to show you beyond this business cycle analysis. Go into discussion of kind of GDP itself and like leading elements of GDP. Mr. Beast, it looks like we dive and now we go up slowly. Maybe. Like I said, that's very potentially what's going to happen. Yeah, because like you look like this right here, it could be very similar to kind of the situation we had here, 99, situation we had here in the mid 80s. Uh, yeah, yeah. It's like there are situations where we've gone negative and then gone back up positive. It really, because the thing is like it does matter how negative you are for this signal. That's the thing. It's like if you're only a little bit negative, then it's not super recessionary. But once you're like way down here, right? Once you're way down here, then it's like, yeah, you're definitely in a recession, right? Like there's basically no point where you got way down here on this chart and you weren't in recession. So it's like we could be here and then just go back up. But if we continue downward, then yeah, it means we're definitely in recession. And I mean, we can break it down by each of those elements, as I already showed you. It's like liquidity is negative, the yield curve is negative in recovery, profits are recovering. So profits would have to roll over, growth would have to continue downward, stocks would have to continue downward, credit is already negative. Policy would have to continue downward because, like I said, this is higher than it looks because of the fact it's on the right axis. Employment's already pretty negative, but it would have to kind of continue in that path. Inflation has already been down and negative, which by the way is actually a good thing. This particular chart, inflation being down is actually a good thing. In fact, for the composite signal, inflation is not actually even in here because of the fact that it's such a lagging indicator in this counter narrative to it. So technically speaking, this composite signal has all of those elements except inflation. I didn't actually even mention that, but that's just because of how the analysis works together. But anyway, let's take a look at GDP as whole, and we're going to take a look at some other kind of ways to think about what's going on. Uh, okay, so looking just specifically at GDP and the pieces that make it up, um, we're going to try to like focus in on specific sectors of the economy that are more leading elements. So, like, what are pieces of the economy we can look at that pretty much either always or most of the time go down before the rest of the economy goes down. And that's going to be kind of like another way we're going to think about this. Now, to do that, you sort of have to understand how GDP is broken up. So that's why I brought the table here. Here you can see we have GDP in total. This is the total amount, and then the total amount is a combination between personal consumption expenditures, gross private domestic investment, and net exports of goods and services. And that net exports of goods and services is where all the tariffs come into play. Now, we're not really going to talk too much about the net exports of goods and services for this part right here, so we can just kind of ignore that. We're really just talking about the personal consumption expenditures and the gross private domestic investment. Now, personal consumption expenditures is split into two categories. goods and services. And then the goods category is also split into two categories of durable goods versus non-durable. Now, um, out of all three of those, durable goods, non-durable goods, and services, which are basically all of the consumer parts of the economy, only one of those is really super economically sensitive, which is durable goods. Non-durable goods would be like canned goods, right? It's like things that are physical goods that you're going to buy, but they're not going to last very long, or really even just like food in general, like non-durable good food, right? It goes bad, right? You buy it, you have to use it. You buy it, you use it, which means that you're going to keep buying it no matter what. You're not going to buy less of it when a recession happens because you have to eat, right? You're gonna buy less of everything else, but you're still going to buy your non-durable goods because you need them to survive. And then services, while services can be a mixture of things you need and a mixture of things you don't need, it still kind of falls into that same camp where you don't really see a huge decline in services when recessions happen because mostly those are the things that people have to keep spending money on no matter what. And really, it ends up for consumers being just the durable goods category that is the thing that is very economically sensitive. Now, so like take a look at this GDP. Here's GDP change of GDP. You can see kind of between like 5 and 15% most of the time. Uh, Going back to the World War II, really between like 5 to 10% for much of the last couple decades. But pretty wide variation within that though. But then if I look, say, at durable goods, durable goods, services, there's durable goods. Now, durable goods here, you can see on this scale, the scale goes up to 20%. That's kind of the highest spikes you see between like -10% and 20%. I go over to durable goods, the highest spikes between 50% and 20%, right? So like coming out of COVID, it spiked up. Durable goods spiked up 40% in 2021, whereas like normal GDP spiked up was 17%. So 3 times as much volatility in the durable goods as there is in GDP as a whole, if that makes sense. And looking over at non-durable goods, you can see non-durable goods doesn't spike up nearly as much. It spikes up kind of more similarly to regular GDP, between 20%, -10%, kind of general base. And then similarly, we can look at services. Services, yeah, also between 20 -15. So a little bit deeper far in there, but even less variability within an individual year there. So in general, it's the durable goods that is the most volatile part of GDP for the consumer portion of GDP. Okay. And now that concept of looking for the most volatile part is basically what we're going to be caring for throughout all these other things. Now, there's also the private domestic investment. This is mostly like business activity, essentially. And then business that's split into fixed investment and change in private inventory. Change in private inventories is exactly what it sounds like. It's just kind of like adding or subtracting from the inventories of everybody. So it's just kind of its own thing. But then there's fixed investment. Fixed investment is split into two categories of non-residential and in residential. And then non-residential is then split up into structures, equipment, and intellectual property products. Now, there are two categories that we care about here are residential and equipment, because residential is homes and stuff like that. But it's a very discretionary purchase on the consumer purchasing end of it. But two, it's also a huge investment in terms of actual product to sell on the business end of it. You have to think about like how many employees, how many raw materials, and just how much capital goes into the building of a home, and how much time it takes. Well, you have to start it well before it's going to be delivered. So that creates a much longer kind of leading element to the economy. And it's similar for equipment. Companies buy new equipment for their factories. They buy new computers, other transportation equipment as well, and all those things have longer lead time on when they're going to be functional. So they end what that creates is a much more volatile movement relative to the overall economy whole. So like for equipment, we look at that rate of change over on a year-over-year basis. What do we end up with? We end up with 40% to -30% for the scale of that. So again, much more volatile than heat. If we look at residential fixed investment, kind of the same thing. what the percent changes on a year-over-year basis, 60% to negative 40%. So huge swings in terms of the activity for residential. Obviously, the biggest negative decline period here of negative 30% year over year in 2009. And it really has stayed in that like negative 20 to 30% range for like 2 years. So that means it was really compounding at that negativity for like a couple of years. So yeah, see, very, very volatile parts of the economy. Uh, as I said, very specifically, durable goods, non-residential equipment, and residential. Those are the key, most volatile parts of the economy. So why am I talking about this? What's the point of bringing all this up and making this big old point of all this? Well, let's take a look at all those pieces together. Here, this here we have all those pieces put together. The blue line is personal consumption expenditures for durable goods, plus the residential fixed investment, plus the non-residential equipment investment. And we basically are looking at the rate of change of all three of those three things combined, which is the blue line there. And then the orange line is basically the same thing, but a slightly different way of adding. Like one of them is a weighted average, the other one's a simple average. But you can see they're pretty much the same line, but they're like two slightly tweaked versions of the same measure. And then with that, I also included gross domestic product, which is itself. So here you can see the year-over-year change of GDP, and here you can see the year-over-year change of the most cyclical parts of GDP. Now, obviously, the volatility within that is one thing to know, but the other thing I kind of want to point out is that you'll see that the orange and the blue lines are going down uh, prior to recession. They're going down first prior to recession, basically every single time. Like you, sometimes they go down and there isn't a recession, like here in 1967, or really get a little bit of a dip down here in 2014 or in 2016, 2017. You see dip downs where there isn't a recession, but never do you have a recession where those didn't dip down and didn't dip down first, because they are the leading elements of the business cycle. Like here, I think in 2009, obviously, is probably the best example of it, where GDP, let's see, at the start of the recession, GDP year over year growth was still solidly positive at like 3.5% nominal year on a year over year basis. And it didn't go negative until basically like a year into that recession. Whereas those leading elements of the economy were had went negative like a year and a half prior to the recession, and were already like deeply negative at the time of the start of the recession. So basically, you could have been watching those signals, seeing that they were significantly negative for several quarters, in order and basically preparing yourself to be like, hey, I think we're going to recession. Hey, I think we're going to recession. Hey, I think we're going to recession. Hey, the recession's here, right? You could have been quarter by quarter, essentially like preparing yourself mentally for it. It was there in the data. Now, within that, obviously, let's take a look at the most recent period of time. Doesn't look very negative, does it? Now, this is obviously just for as of Q4 2024. So the last 3 months, we don't have any information on yet, and we won't get that data point for about another month or so. But not negative. Not they weren't even really trending downward. In fact, you would argue that they were trending upward, right? Um, so I will say this: unless something for this particular measure, this is just one particular measure here, but unless something dramatic changes, it looks to me like we would need at least a few quarters to really build up the amount of negativity in order to reach recessionary levels. It's hard to say. Hard to say. Now, I mean, obviously, if you look back, like say 2020, it's like that was a flash recession, right? That was brought on uh, by man-made decisions. I call the lockdowns man-made decisions. Obviously, people argue about the COVID itself and the disease and all that and whatnot. But whatever. If I'm going to argue that the choice to do lockdown was essentially a decision. So essentially, this was like a flash recession of sorts, and some people think we're essentially potentially preparing ourselves for a flash recession again. So it's like taking those two things into account. It's like, well, what do we have here? We still had things that were going negative prior to that, and then when they did go negative, they still went negative to a certain degree and then bounced back. So it's like
I don't know. I feel like things would have to get pretty negative for these series to break down that quickly. Now, again, this is on a quarterly basis, so it's worth noting that if you could get a more timely series for basically the same piece of information, then you could perhaps get a little bit more of a lead time on what's actually happening. Now, okay, and then this chart right here, by the way, is basically the same information, but in real GDP terms. So, like over here, all these measures are in nominal terms. And then if I switch to this chart here, I basically created the same information, but in real GDP growth, which is still positive, by the way, still in positive territory. But unfortunately, those real GDP time series only go back to 2000. So that's why I didn't really focus too much on this graph because really we have it across one cycle. Whereas this one we have across several cycles. But anyway, the point is, even in real GDP terms, these all these signals appear to be positive, at least in the short run. So then moving forward, like I said, what happened? What if we were to take into account on a monthly basis? Now the truth is that we actually sort of can do that. It's like what we can do is we can substitute in these quarterly GDP measures for monthly series that give us very similar pieces of information. So looking at that, what I've included here is vehicle sales, one family homes sold, as well as the monthly series of personal consumption durable goods expenditure, which isn't a perfect fit. Vehicle sales is basically meant to be my proxy for durable goods for consumer, or not for durable goods. Vehicle sales is basically my proxy for business equipment. One family home sales is basically my proxy for residential investment. And then personal consumption expenditures, durable goods, is my proxy for durable goods. Basically, we didn't need a proxy for that. There actually is a monthly series for that particular one. And then all of these I adjusted for population because like vehicle sales and family home sales, those shifted in time over the course of time. So all those have all been adjusted for population, and then looking at the rate of change of growth on each of those series, which is what this blue line is. So here you see the blue line is a monthly series of basically those three things put together on an average rate of change basis. And then the green line is real GDP growth. You can see they're pretty well correlated with each other. Now, obviously, the blue line is much more volatile, and they don't seem super well fit, but that's because real GDP is just way less volatile. What I could do to kind of show you how well they fit together is I could shift one line to the right hand side, but unfortunately, I'm pretty sure that what Fred's going to do is it's not going to keep the y axis with each other and to do that. Oh, actually, no, on this one it actually did do it too. Never mind. Sometimes it'll shift the zero down. So that's worry about that. But if I shift it one to the left side, one to the right side, you can see they move down, they move up pretty well together. Just that the blue line is much more volatile than the green line. But in general, very, very well correlated. And the blue line goes negative before the green line does. That's, again, giving us our lead element. You'll see that it will have negative months sometimes for a while. So what you really need to see is you need to see the blue line negative for 6 months, 12 months at a time before you really can feel confident about it. It's definitely something where it would require a lot of data points before you really start to feel confident in it. But nonetheless, you can get basically this same information here on somewhat of a monthly basis if you're willing to substitute it something a little bit different. So within that context, obviously, let's take a look at the last 10 years. Here we are, technically in positive territory as of February, but we've been kind of skirting the line of zero for really the last year, right? We've kind of been hovering around the 0 point for basically the last year or so. And then you can see we were in pretty significant territory for 2022 going into the first half of 2023 as well. So kind of paints a picture of those last 3 years. The way like I said, I think if you want to be good with your economic series, you really want to be able to explain the last 3 years relatively well. So this time series, I think, does do a pretty good job of that. So that's pretty good. But again, still a positive territory. As I obviously, like I said, we've had a few negative months recently, but as I also said, you really need to see massively negative months, and many of them, like 3 to 6 months of massively negative territory, negative 10, 15, 20% for like 3 to 6 months. Well, we really just don't have that. So, and doesn't appear to be anywhere in the near future. But again, this is as of February. So who knows? Once we get that March data, maybe it'll start to be negative. But even then, I wouldn't feel confident in this time series for like 3 6 months or past that point. Now, taking this, like I said, this is just one way to do it. I've kind of taken this same approach and applied it to a variety of other measures as well. So here I took there's a time series where they release manufacturers' new orders, and I basically did the same thing with the manufacturers' new order series. I went and found the consumer durable goods, and then I also went and found the construction materials and supplies, and then I went and also found the non-defense capital goods excluding aircraft. Consumer durable goods are consumer durable goods. The construction materials and supplies is going to be my proxy for residential investment, and then non-defense capital goods, excluding aircraft, is going to be my proxy for non-residential business equipment. Okay, and so all three of those measures put together, adjusted for population growth, and also adjusted for inflation when relevant. And then for this one, I did the same thing as I showed you before, where it's like I have one that's a weighted average measure, another one that's a simple average measure, but they're roughly the same thing. They're just slight tweaks on basically the same measure. And then with that, I have a real GDP growth. So here you can see, likewise, another series that is well correlated, leads at least by a handful of months, and is also more volatile on a monthly basis. Where does it show we are currently? It shows that we're in negative territory, and we've been in negative territory for really the last like 3 years. This particular series, we weren't really able to. It doesn't really show a particularly bullish 2023 and 2024 like we had. We just happened to have a 2023 and 24 that was bullish nonetheless. But I will say is like while we have been negative for the last couple of years here on this time series, you'll notice against the whole time series. The whole back end of that thing. There we go. One thing that you'll notice in general is that when it does go into recession, it's massively negative, right? Negative 10%, 15%, 20% on a monthly basis for several months in a row. Whereas here we're just at a 1 or 2 percentage points negative. So not really the scale we would expect if this signal was showing us the recession. Now again, doing the same thing, but this time instead of with manufacturers' new orders, now we're using our industrial productivity index. I have the industrial productivity index for business equipment, the industrial productivity index for construction supplies, and the industrial productivity index for durable goods materials. And then also included the durable goods energy materials. It was like this particular series had a few different ways of slicing dicing the data, so I technically included a fourth one in this one that had a slightly more extra lead element to it. Just it was kind of unique to the productivity measure, but in general, basically the same concept. We're just applying these three kind of leading series and then comparing it to real GDP. And in general, you can see it's more volatile. More often than not, it goes negative prior to real GDP and does it much more deeply as well. So it gives you a way to kind of say like, okay, what does the current economic data look like? Does it look like we're actually going into recession or not? And if you look at the last few years or so, you can see that we've been declining over the last few years. We've been kind of hovering around the 0 point for much of 23 and 24. But it's actually worth noting that since November, this measure has actually moved into positive, only a little bit into positive territory. So who knows? Maybe that'll reverse. But yeah, as you can see here, it looks like according to productivity, just like according to new orders, just like according to raw monthly series, just like according to the quarterly GDP growth series, all of these are not really showing us in recession yet. And at kind of a base level minimum, it seems to imply that we would need like 3 to 6 months at a minimum to get there. So moving on from that too, the productivity one. Then I also, this is the last one. Okay, and then this is the last measure where I did basically the same thing. Like I said, did several of these measures, all very, very similar, very, very kind of similar concept and approach to constructing these, but using different data series to construct them. This one is constructed from employment data, the employment levels for construction and extraction occupation, the employment levels for production occupation, the employment levels for transportation and material moving occupation, the employment level for sales and related occupation. So all those are much more leading elements of the employment data, which remember what we had said is the employment data tends to be very laggy. So if you can get a leading element on employment data, that is very, very helpful. And so, yeah, great parsing apart the employment data to look at specific economically sensitive leading elements of the economy I do think helps you paint a picture of what's happening a little bit quicker, a little bit sooner. And then compared with that, we still have real GDP growth. Here you can see that the blue series does decline sooner and quicker and harder than the real GDP series. So still also another pretty good lead. And then looking at the most recent few years, we are in negative territory, but not deeply negative. So it's one of those things where it's like just been hovering along this kind of zero line for a few years now. The economy has uh, been getting weak or is weak and has been getting weaker, but we're really just not at the precipice of collapse yet. So then, okay, those are all my series of for specifically trying to kind of uh, track or parse out economic growth. Like all of those basically were we were comparing it to real GDP growth across the board, right? So like all those, the whole purpose of them was basically to be like, is there another way we can estimate what's happening with GDP growth without actually having to wait to the end of the quarter, wait a month and a half after the end of the quarter when they release the series, because that just takes so long. Okay, so it's like you can look at things on a monthly basis. It helps to give you a better idea of what's really going on. So then there are other measures, there are other economic data that I kind of wanted to look at too. There's other things to kind of take into account of what's going on with the economy. But this is kind of like a more random grab bag of stuff to look at, but things to kind of take into account. As I said, I'm kind of been tracking what's going on with the new administration on many different levels, whether it's with the tariff situation, but also with Doge. So here, this chart, I have all federal employees as a percentage of population here in the blue line. Then also state government employees as a percentage of the population, which is the orange line. State government uh, plus local government uh, as a percentage of the population. Orange line. And then the green line is also all social assistance employees as a percentage of the population. I bring this up because obviously, what with Doge doing all their federal employee layoffs and cutting of contracts, and those contracts are related to social assistance, so that's why they're here. Everyone's worried about all those layoffs bringing us into recession, or at least I would say people were worried about that. I would say like a month and a half ago, but in the last month, I haven't really heard anybody talking about those things because now everyone's just talking about tariffs and people aren't talking about whether Doge is going to pull us into recession. Now it's about tariffs are going to pull us, right? But the point is when people were concerned about that, I was looking at these things. I was trying to say, okay, well, what's the situation with that? What percentage of the population really works in these areas, and should we be concerned? So looking at that, I would say it's it's a little bit less than 1% of the population is employed by the federal government. And then it's a little bit less than 3% of the population that's employed by state and local government. So combined together, that's about 4% of the population that is employed by any government whatsoever in the United States. And then we have about a 1.5% more in social assistance, which social assistance, I mean, there's plenty of social assistance that would exist regardless of government, but obviously a lot of government like funding goes to social assistance programs. So in a sense, those kind of become like outsourced workers. I kind of think of it like that's why I put them together, because essentially it's like it's tax dollars that are funding all three of these, right? Uh, maybe maybe uh, maybe only half of the green line is funded with tax dollars, right? I don't know what a percentage is. I'm just kind of guessing. But the point is like orange and blue, 100% funded by tax dollars. Green line, some percentage funded by tax dollars. So that's why I include these here. Now, obviously, we only have a couple months here, but here in the months of February and March, I will say that we have not particularly seen gigantic decline here. For the federal employees, we went from 883 basis points, not even basis, technically it's 88 basis points. We went from 88 basis points of employees in January, federal employees, to 87 basis points federal employees. Or it's actually rounded. That's actually rounded. It's still technically 88. So we lost half a basis point in population terms uh, of federal employees in the last 2 months. Hold on. Goes math. Okay. So 16, 17,000. Okay, so my estimate based off that, it's about 17,000 federal employees have lost their jobs in the last 2 months, according to this. That assumes population constant across those 3 months. So that you could argue that that's a big assumption there. But the point is like not very many federal employees yet. Now, obviously, this could be a thing that moves slowly and then kind of then makes a big lurch all at once. It's possible that one because of the buyout packages or whatever, maybe we really won't see this start to spike up for like 3 to 6 months as possible. So that's something I'm tracking every month, definitely. And then also I would point out that the social assistant worker employment increased over those 2 or 3 months, and state and local employees also increased over those 2 or 3 months. So it's like if we combined all three of these lines together, I'm not sure that there was actually a decline at all, whatsoever. But again, like I said, maybe it requires 3 to 6 months before we would really see some actual movement in this. So while I am pointing that out, it's not to me to say, oh, don't worry about any of that. Don't take that as like me callously saying that we shouldn't worry about this. I'm just saying that it certainly is not showing itself up in the numbers yet. It could maybe never show up because at the end of the day, I think they really are only just kind of weeding around the edges. They're pissing off a lot of people to do it, but they're really just kind of like tweaking the details, not really doing much. So anyway, that's specifically focused on the employment picture for federal employees. Now here, zoomed in on that, I have the employment picture across a variety of different groupings of professions: management, business, and financial occupations, professional and related occupations, sales, service occupations, sales and related occupations, office administrative, construction, extraction, production, transportation, and material moving occupations. Anyway, all of them here, we're not going to look at each of them individually, just kind of want to point out the overall trend. They're all still relatively low. You can see kind of like a little bit of an upward spike happening here in construction and extraction opportunities, which is this one that's up here at the highest point, about 8.3%. But you'll see that it has this like strong cyclical kind of seasonal zigzagging always. So here it appears that we're just kind of at the peak of that zigzag, which means it could be arbitrarily higher than it looks at exact point in time. It's like 7. The point is like we're still down at pretty low levels, very low historical levels. Watching it on a monthly basis, some of these series will move up sooner than others. It will be more of a warning sign, like those economically sensitive series as we were talking about. But as you can see, as of right now, still very low levels. No major causes for concern within inflation data. I think we're actually yep talking about inflation because I'm talking about. I kind of want to try to get to a wrap up on the stream at some point, so we'll skip past the inflation screen. Here I have initial claims as a percent of the civilian labor force. I always like to normalize something by some sort of ratio. Um, so initial claims, ultra low levels, ultra low levels, 13 basis points, very, very low level. What kind of levels did we see before things were a warning sign? Like, let's see. Uh, prior to the recession even beginning, prior to the recession even beginning in the great financial crisis, we were up at like 20 and change basis points of percentage of civilian labor force initial claim. We're below that now. Like we're at 13, 14, 12 basis. So you can see like we're literally at like 2/3 of the level of initial claims that we had and in like the years prior to the Great Financial Crisis, 2005, 2006, 2007, like before there was a real crisis, when it was just totally normal low levels, we're still at even lower levels than that, and which was low levels compared to the previous cycle, which was low levels to the cycle compared to that, which was low levels compared to the cycle before that. So it's like, oh man, unemployment is just so low, and it's just one of those things where it's like until the employment picture really starts to deteriorate, uh, honestly, all of the recession concerns just massively overblown. Now it's true that because of how tariffs work, true that it could change very quickly. So it's one of those things where we are trying to watch it like a hawk because we know that that's where the change will occur if it's going to occur. But it's one of those things where it's like, well, it happens. It just has not happened yet. And it's worth noting that initial claims comes out weekly, so that's a weekly too. Civilian labor force, it's not, that's a monthly series, so technically Because like you'll see here, it's not trailing to April really kind of. So technically speaking, because of the fact I'm normalizing it by population, it's a monthly series, but you can technically look at the initial claim, which isn't adjusted by population, but obviously you can see you don't really need to do much adjusting for population. I do that just because I'm a nerd that makes a big deal about normalizing charts and graphs and things. But I mean, you don't really need to bother with normalization for this time. You can just watch this and wait till it spikes. It's like here we are, 200,000 per week or whatever. It's like until this bad boy is like what? Until we're at least over 300,000. It's just not even worth talking. At least. Um, but 300,000 was again not recessionary for 2005, 2006, 2007. It was totally normal, not in recession at all. So yeah, like initial claims, easily one of the most leading parts of the employment picture you can get that comes out weekly. Continuing claims, basically same thing, also comes out weekly. I also like to normalize it for civilian labor force. This continued claims is like people who are actually really collecting on unemployment. So like this is really a more proper measure of people who are going into unemployment, whereas initial claims could just be some like some friction between jobs a little bit. So this is a little bit more of a proper measure of unemployment, but initial claims is a little bit on. But here, still massively low levels, about 1%, 1%, 1% prior to 2020 was pretty normal. 1.5% was normal prior to the Great Financial Crisis. 1.5% was normal in the 90s. 2% was normal in the 80s. So yeah, 1%, barely even budging. Very, very easy. Um, Temporary help as a percentage of civilian labor force. I saw people talking about this quite a lot during 22, 23. People were talking about like, oh, temporary help is drying up. Here's the temporary help measures, and indeed, it has dried up quite a lot over the years. And it's kind of interesting to think about like maybe what's going on here. I've heard some arguments that the push for gig work could be the reason why this is declining so quickly. It could be that because Uber and Lyft and stuff has become like such a mainstay that rather than going on initial claims or unemployment insurance or getting temporary temp job, a lot of people will just go and download the Uber app and become a Uber driver. So I've heard some arguments that that's partially why this is going on like this, but it is worth noting it's been declining pretty significantly, and usually you do see declines going into recession. So like this is one employment measure that actually does paint a pretty negative picture. But like I said, been painting that negative picture for like 3 years straight, and people have come up with some good argument for why that picture may be just changing over time. Because obviously we've gone through changes in the past, right? So obviously we had a massively low level stroke here in the 90s, and then something about the 90s made temp jobs come in vogue, I guess, right? Like that's kind of what's happening here. Is like I guess temp work just became like all the rage, or at least more the rage than it was, right? We went from like 10 basis points of the labor force in temp jobs to 1%, 1.5% that. So that's like a 15x, like a 15x in temp help over the course of a decade, right? So obviously you can go through like a secular change where it just becomes more normal. Well, maybe we're reversing that trend right now. I don't know. But the point is, this is another employment measure that I like to pay attention to. One that definitely paints a more negative picture than these ones. Going on from that, there's also the cyclical rate of unemployment. There's actually the non-cyclical rate of unemployment. The Fed estimates the non-cyclical rate of unemployment, which is basically what they say is like the steady state unemployment rate. And then if you subtract that from the unemployment rate, it essentially gives you an idea of how much excess or depressed level of unemployment you have relative to the overall cycle. So if the curve is below the black line, it means that labor markets are tight, and if it's above the black line, it means labor markets are loose, unemployment is high. And based off that, you can see here in the last few years, we actually do have. You see, we do have we've had a very tight market for several years. That's what people were talking about, right? Oh, tight labor market. Everyone talked about the tight labor market for 2022, 20. Everyone talked about tight labor market. And you see, it's become less tight, but we still have not reached excess unemployment. we're just a little bit below the excess unemployment level. So that's something to maybe keep in account. Either that does indeed start to spike up prior to recession, but you can see it can be in negative territory and then spike towards positive territory at the start of recession. So it's not that, oh, if we're nowhere near a zero, that means we can't go into recession. It's like, no, no, no. Actually, you could start from that negative level and go up to positive territory for a recession. That does occur. So, but the fact that we're kind of already around there means that I don't know. You would still have to see a big spike. Not really seeing a spike where. Then there are job openings as a percentage of the civilian labor force, which you see historically has normally been like 2 to 4%. 2 to 4% suddenly became normal to have like 3 to 6%. Now it's at 4 or 5%. So lots of job openings apparently relative to the civilian labor force. Now I've heard people also talk about uh, some of the uh, some of the falseness of some of those job openings. Like some of those jobs could essentially like they know that they're not going to be filled, but they're kind of just leaving jobs up there that are at unsatisfactory salaries or have unsatisfactory working conditions, or potentially they know that there aren't people that are technically skilled enough to fill those roles, but they leave them up. So like I've heard arguments that the fact that we have so many job openings relative to history could be a thing where a lot of people are kind of putting up like almost faux job openings or like job openings for show, so to speak. I've heard kind of some arguments about this, but this is something that you generally see declining pretty significantly prior to recession. So I would say now we're back to down to like a normal level. We were declining, but now we're sort of back to a normal level. Normal being where we were prior to COVID anyway, which was already on the back of a pretty significant rise. So either way, the point is I would expect to see this decline precipitously. We were into recession as well. This series also comes out on a then quits. This usually comes out basically at the same time. You can see how very closely aligned they are with each other. So it's really kind of like another measure. This is the quits rate. It's different than the job openings, but they do tend to move pretty closely with each other. That one, this one is also. I thought this was important. Um, Back today. Okay, so that's all the employment measures, and then this is gonna be the last thing I'm gonna point out because I think this is something that anybody who's listening, they should maybe put this on their thing to really pay attention to. Like I've showed you lots of things you can pay attention to over the next weeks, months, quarters to try to get an idea of what's going on with the economy. But if you want something to look at on like a day-to-day basis, if you want to have an idea of like just how scared should I be of what's going on in the economy, I would say uh, go try to find this particular time series. Um, Now, I have it set up a specific way where because you want to have a spread. Specifically, I would say is like go find the high yield index. Yield to worst is what I would do because that shows what the yields would look like under certain loss conditions. But just get a high yield bond index spread of some sort, and subtract out the risk-free rate. And you want to spread, not just the rate itself. I mean, the rate itself will blow up in a crisis, as you can see right here, but the spread itself is going to blow up even more. So it's something that if you subtract out the risk-free rate, it'll be a much more fine-tuned measure of risk specific. So that's kind of what I have here. Is I have the high yield spread to worst, subtracting out an average between different rates because the spread can be used by different people at different maturities. So that's kind of my way of averaging out the kind of fluctuated differences here. But the point is this is something that sometimes spikes early in recessions. Sometimes it spikes basically at the same time as a recession, but it's something you can look at to really get an idea of is the market freaking out or not. Because what this is a market price estimate of risk, specifically in the bond market. This is the bond market pricing in the potential for serious credit. This is them saying that we think that we're going to have defaults. Is when this starts to spike up. And I bring that up because obviously, if you look closely here in last last couple month and a half, last month and a half or so, we've seen a pretty significant spike up. Now that spike up is not that high relative to where we've been the last few years. Like we're literally the spread is now back to basically where it was in mid 2023, right? During the SVB crisis, like spiked up to these levels, and it had been at that level even in 2022 as well. So like We're not at some like crazy recessionary level right now, but we are in the midst of a pretty decent spike. So that spike could be nearing an end right now, and it could be that we're, as I said several times at the kind of the start of this, it could be that we're reaching sort of a temporary bottom in the markets potentially. But the point is this is definitely something to watch, and this does come out every single day. It only updates after the close. So like here, the last data point is Friday the 4th, and we won't get April 7th data point until tomorrow. But nonetheless, it's something that you can look at and see like, okay, well, based off the market activity yesterday, do I think the market is overreacting or underreacting? Right. So like if the market drops 10% tomorrow, but this measure comes down over the same period of time, then that would I would say implies an overreaction, right? Because like if the market is crashing, this should be spiking. If this is not spiking, the market is crashing, then that becomes a buying opportunity. Now, obviously, as I've kind of said, it is spiking and we are crashing. But the point is you kind of have to make also some sort of estimate of how much. As 4% or what is it, 4.7% is not a high level for this measure, as you can see. It's like if we look at over the course of the whole history, which goes back to 1960s, unfortunately. I don't know what the average is over this time series, but the average I would think is like at least 5%, like 5-6% or something like that. So it's like 4.7%. We're still below average, right? In fact, like I'm pretty sure I had even commented on this to somebody only like a month or two ago, where I had even said like, talk to me when this baby gets over 5%. And admittedly, we're getting there. But when I say over 5%, I mean significantly over 5%. Show me it when it's at when we're getting over 7, 8, right? Like that's where when we were at going into the financial crisis. That's when we were going into the dot com. Uh, that's when we were going into the COVID crash, right? Really when you're up there. So this is something I would say is like if you really want a very very timely economic series to look at on a regular basis, like I said, you really look at it every day. Not in time, you have to look at it a 1 day delay, but nonetheless comes out daily. So you can kind of compare this with the markets and be like, okay, well, the market was down this much yesterday, and this didn't really move that much. Maybe I should buy the dip, right? So like today we had a down day today, but if I wake up tomorrow morning and it shows that this came down a little bit, well then maybe that's a buy signal. Like I said, that's a very loose one element prediction thing. I would buy. Just trying to share things you can look at. This is something you can watch in real time to get an idea of if uh, if we are really going into recession or not. Because spreads blowing out is something that the smart money is going to be doing with their bonds to ensure that they don't take massive credit. So, all right, that's pretty much it for today. We didn't even really get to do the kind of tariff discussion I wanted to do. Maybe we'll do some of that next week or not. I did kind of actually want to go into um, some of the numbers on the tariffs. I actually did like do some number crunching this weekend, trying to kind of estimate some of the potential effects of the tariffs, which unfortunately that is very very hard to do. It is so hard to really kind of try to think through what the actual effects of the tariffs are going to be because there's like so many secondary and tertiary uh, factors to take into account, like the retaliations, like whether people retaliate, how much they retaliate, who retaliates versus who doesn't retaliate, what types of deals are struck, uh, all those things. How much of the cost gets passed on to the consumers versus how much do producers choose to eat the cost themselves versus how much do consumers choose to substitute their products. It's extraordinarily difficult to really parse out. But I did try to do that. I did actually do a whole bunch of estimates. I took the tariff board and estimated what the tariffs are, took a look at what all the imports were from those countries, estimated what the tax revenues would be if they were to get those tariffs, adjusted those tax revenues based off of how much products I think would be substituted versus how much of the tariffs get absorbed. But I did a whole bunch of estimates here. Like I said, it depends on like too many variables to really give you all like, oh, well, here's my best guess of what's going to happen. All I can say is that it really does vary a lot. Anywhere like I feel like real GDP growth for the United States could be anywhere between positive 2% and -3% for 2025. And unemployment uh, for 2025 could be anywhere between 4.5% and 7.5%. And the amount of the deficit that gets decreased by the tariffs could be anywhere between uh, 0% and like 75%. It's like there's a wide range of outcomes depending on all these other factors, all these different things that happen. So it is really really hard to kind of parse out the details. My kind of base case, my base case assumption is that GDP growth for the United States for the year 2025 is basically going to be about zero. Real GDP growth is going to be about zero. That the unemployment rate is going to spike up to uh, I don't know that even that one I have hard giving like a base case for. It's like the GDP growth I feel like is a little bit easier to give a base case for, but then the unemployment one's a little bit hard to give a base for. I sort of want to give a base case of 5% for unemployment, but I also sort of want to give a base case of about 6% for unemployment. So it's like I don't know. I'm somewhere in between there. But like I said, I can see it going to 7.5% for certain circumstances. It depends on a lot. It depends on a lot. But point is, yeah, I mean, it all depends on whether the tariffs stay too. That's the other thing. So many people are convinced that all of this is still basically just a giant negotiation tactic, and I think that that's true to a certain extent. But I do think the administration kind of talks out of both sides of its mouth in terms of what it wants the tariffs for. Like it says it wants the tariffs for revenue. It says it wants the tariffs as a negotiation tool, and it says it wants the tariffs to help manufacturing in the United States. And the point is all three of those things are completely different goals that in order to achieve them, you actually sort of have to go about the strategy differently, and you can't really end up with the same place, right? Like if the tariffs are a negotiation strategy, that implies that you end up with lower tariffs after the negotiation. But if you end up with lower tariffs after the negotiation, that implies that the tariffs are not a revenue source. And if the tariffs are not a revenue source, then that implies that you're not actually doing much fixing to the trade deficit. So as you can see, it's like these three supposed reasons for having the tariffs are all technically at odds with each other. And so, in a sense, it kind of makes it so that it can't be all three. It can really only be one or maybe two out of the three. Um, and it's hard to tell which one it is. I feel like a lot of people do believe still that the tariffs are just a negotiation tool, but I think you sort of have to run with the base case assumption that they're not. That's kind of what I did with these numbers here. So yeah, I don't know. If I guess I'm going to throw a number at it. I'm going to say my base case assumption is that real GDP growth in the United States for 2025 is 0%, that the unemployment rate spikes up to 5.5%, which I say spike, by the way. 5.5% would not be a super high level. It would potentially still be recessionary, but it would not be like, massive depression crisis or anything like that. It would be a kind of shallowish recession. But of course, it also depends on how fast people bounce back. That's the other thing. And then, oh yeah, the other element I would say is that with that, so zero GDP growth, 5.5% unemployment rate, and potentially a 30 to 40% reduction in the federal deficit from the tax revenue. But again, like I said, it's such a wide distribution of outcomes that even that base case assumption, I have very little confidence. We're really just kind of playing it by ear. So that's what it is. So that's pretty much going to be it for today. We talked about a whole lot of things. I do feel like it was a little rambly and not necessarily super well organized, but I hope those that watched felt like there was useful information and was valuable to them nonetheless. I kind of felt that way with my long stream on FG last week, but at least with last week's stream, I felt like I kind of stuck to the plan in terms of everything I discussed. Whereas with this one, I didn't even get to discuss like half the things I did want to discuss. But I also didn't want to stream for 4 hours today either. So that is what that is. So anyway, that's gonna be it for today. Hope you all have a good rest of your week. Presumably, we'll be streaming again next weekend. I probably talking more about individual companies at that point in time, but we'll see. Still thinking through stuff on the end. So, all right, I'll catch you all in the next one.